Accruals. Accrual accounting concept. Know that accrual based accounting is the official accounting method followed by companies. Accrual accounting is guided by several accounting principles, two of which are the revenue recognition principle and the matching principle. These principles dictate the timing of when revenue and the expense transactions are recognized in the company books. Definition. Accrual concept means a transaction is recorded in the time period it occurs. Hence, a revenue transaction is recorded in the time period it is earned, irrespective of payment received or not. Expense transaction is recorded in the time period it is incurred, irrespective of payment paid or not. Accrual accounting versus cash accounting. One simple key difference: accrual accounting transaction is recorded as it occurs. Cash accounting transaction is recorded when money or cash moves. Why do we use accrual based accounting? Accrual based accounting is followed by companies as doing so reflects a business's financial activity more accurately and improves the accuracy of financial statements. We will understand this more closely using examples. First example is a revenue transaction. Let's understand using a credit sales example. Company sells services worth 40,000 in January and this is a credit sales. Customer agrees to pay next month, which is February month. As per cash accounting, we can record this sales transaction only in the month of February when we are actually receiving cash. Let's assume customer paid on 8th February. Transaction on 8th February as per cash basis accounting will be sales account credited by 40,000, cash account debited by 40,000. Now, if we generate a profit and loss statement for the business for the month of January, this will not be accurate because the sales is nil as per cash accounting basis. A simple profit and loss statement for business for January month: revenue nil, expense nil, profit nil. Now, if we are using accrual accounting, it allows us to accrue or record the sales transaction in the January month accounting period. So this credit sales transaction will be recorded in January. Sales account credited by 40,000, sales receivable account debited by 40,000. And when we actually receive the payment from the customer on 8th of Feb, another transaction will be recorded, which is sales receivable credited by 40,000, cash account debited by 40,000. Now, the profit and loss statement for the month of January will be accurate and reflect the sales for the January month. So the simple profit and loss statement for the business for January month: revenue 40,000, expense nil, profit 40,000. Please like and subscribe if you are finding this content helpful and useful. Another example we take of expense. Let's understand using a payroll salary expense example. Employee A monthly salary is 10,000. Company pays employee salary on 10th of every month for the previous month. Employee A works for January month. As per company policy, on 10th of February, company will pay employee his January month salary, either cash or bank. Transaction on 10th of February as per cash basis accounting will be salary account debited by 10,000, cash account credited by 10,000. Now, if we generate a profit and loss statement for the month of January, it will not be accurate as the January salary expense is not recorded in the January month. So the simple profit and loss statement for the business for the month of January: revenue 40,000, expense nil, profit 40,000. And this is not reflecting the business accurately. But accrual accounting allows us to record the salary expense transaction in the January month accounting period. So transaction on 31st January, salary account debited 10,000, salary accrual account credited 10,000. So transaction on 10th of February, salary accrual account debited 10,000, cash account credited 10,000. The salary accrual entry recorded on 31st January is also kind of adjustment entry. Now the profit and loss statement for January month will be accurate and reflect the salary expense for the January month. Simple profit and loss statement for the business for January month: revenue 40,000, expense 10,000, profit 30,000. Please like and subscribe. Give comments. This will motivate me and help me to improve and create more informative content. Happy learning. Thanks for viewing.